Welcome to the Macro Anchor podcast powered by the Prague Finance Institute. I'm Andre Chelhot, Chief Economist of the Prague Finance Institute. Our podcast is planning to do regular interviews with prominent macro and international economists and geopolitical strategists to understand the ongoing developments in today's world economy and markets. We welcome today a very special guest, Mr. Themos Fiotakis. He's the Global Head of FX Strategy and EM Macro Strategy at Barclays. In that capacity, he's responsible for the bank's FX forecasts and strategy views across DM and EM currencies, as well as local EM rates. Welcome, Themos.
Great to be here. Thank you very much for the invite. It's an honor.
Thank you, Themos. We have a list of questions for you, given your expertise on the international FX markets, and we're going to start by the global economy. What is your current outlook for the global economy for 2025? What are the major economic tailwinds and headwinds? Which countries are going to outperform and which countries are going to underperform? And what would be the impact of divergence in growth on global FX markets and FX volatility?
Thanks for the question. I think it's one of the most central questions that you can put together. I think that as you hinted at it, our outlook is one of divergent paths for growth. On the one hand, the US economy, which has been exceptionally resilient on this path of strong consumption feeding into strong labor markets, feeding back into strong consumption, extending further on the back of further policy support. On the other hand, you have very anemic growth rates in Europe and China, the two other big pillars of growth globally, which are likely to get hit even further by certain US policies, including deregulation and tariffs. The big question mark, obviously, is to what extent there is a policy support to offset these things. And as we all know, the lack of policy support in Europe and the half-hearted policy support out of China probably means that growth takes the hit disproportionately for not just these two pillars, but the non-US growth rates. And it also leads to monetary policy divergence as well.
Okay, so it's going to have an impact on FX volatility, in your opinion?
I think it's going to have an impact on FX moves. So there is a big difference between volatility and moves. If you have, for instance, a currency trending by, 0.3% every single day, by the end of the month, you will have a pretty large move without volatility, basically, right? Whether you have a choppy market or not will depend a lot on risk appetite. And I do believe that risk appetite will remain healthy, but you will likely have events that will lead within a steady market, not a very choppy market, will lead to large currency moves. And our forecasts, together with our assessment of risks, are geared towards exchange rates that move a fair amount within this next few months.
Okay, thank you. We can move now to how do you explain the resilience of the already in recession based on the PMI indices? That's my first question. If you would like to answer this first question, please.
I think there's a couple of factors. The first one is that you have these lags in the European economy. Usually, wage growth comes after inflation rates. So you had the spike in inflation a few years back, and then a lagged process where wages caught up. That supported domestic expenditure more broadly. That process is coming to some kind of end at the moment. The other reason is that, as you know really well, Europe is a very imbalanced monetary project. Whenever you have very tight conditions at the core, Germany and France, you tend to have looser conditions at the periphery and vice versa. So the decade of the Greek crises or the peripheral crises had very tight fiscal and monetary conditions for Europe, for Greece, for Spain, for Italy, etc., and very loose conditions for Germany, France, etc. And in contrast, we are going through a period where the core now is having fundamental problems because of the industrial sector, which you mentioned. That is leading at a first rate to much looser fiscal conditions than what the periphery has experienced before. Those loose fiscal conditions have supported spending and consumption at the periphery. These are economies that tend to benefit a lot from shifts in fiscal stance and attitudes. And also, you can expect that dichotomy to continue as the industrial sector gets hit. The periphery will probably continue to do well now, backed by looser monetary policy as well. In many ways, Europe today resembles a little bit more how Europe used to look in early 2000s, where the core was the sick man and the periphery was doing better on the back of looser conditions because the core had these issues.
To talk about the core, what is your take on the recent political and economic developments in Germany and most recently in France yesterday? Will the two countries succeed in forming new and stable coalition governments? What do you think?
I think that a few things. I mean, you can talk about the events themselves, and the events themselves, I think they were a long time coming. In many ways, France has had a long period of falling out of love with central Macron policies, centralist Macron policies, and a long period where the opposition has been very vocal about very peripheral issues, let's just say, and they have gained market share on the back of that. That has led to a pretty tricky outcome in the recent elections and a very unstable government. That instability was something that we thought that would come back to haunt us. It came a lot earlier than we expected, but that's the nature of budgets that tend to speed up political developments. Political developments in Germany got sped up as well by the Trump victory because it will bring a lot of very big questions to Europe, from tariffs all the way to national security. And obviously, this government was for a long time had lost the confidence of the domestic political system that it can deal with these kind of pressures. So this gives opportunities for descendants to just press the agenda further. But I think the big picture is to take one step back. Europe had escaped by luck the deindustrialization that the US experienced in the early part of 2000s on the back of China's ascent to the World Trade Organization. They escaped that by creating a symbiotic growth model with China. They became part of the assembly line of the Chinese economy, and they grew together. In the early 2000s, the Europe 30% exports to GDP. Now it's 55% exports to GDP, including intra-European trade. It became more and more open, more and more reliant on global growth. But the last few years, and responding to Trump's initial tariff war, China has taken the decision of growing vertically, integrating across the value-added chain, which means that it has become a lot more competitive to Germany, to Japan, to Korea, and to the industrial nations. For the first time now, the core of Europe, the industrial nations of Europe, are experiencing what true competition from China means, something which other places have experienced 20 years ago. They're called to give an answer. The discussion is not yet there. Macronists try to bring the discussion there. But the reality is that both in France and in Germany, the conversation is elsewhere. And because it's easy at times of crisis, that conversation to just get out of hand, it has been the case that it has translated, that pressure has translated into a crisis which is of politics, which will probably need to take its course, right? We're not anywhere close to some kind of resolution.
To move to France, we have the news recently. Is France caught in a debt trap? I mean, the deficit is projected to be around 6%. And from yesterday's vote, we see that for 2025, not much is going to change. and debt to GDP ratio is already at 110%. What do you think the policy over there regarding the trajectory of the debt?
That's a very good question. So to put first things first, I would say that the the government sector is one of the three main sectors of the economy. Government, households, and companies. While the French government has a big deficit, the sum of the private sector is in a better place. So the external balance is not as dramatic as the government balance. That doesn't mean that they can. There's obviously rating agencies. There's also a lot of ways that government debt matters by itself, but it gives you a sense of why, absent political instability, the market has not been that concerned until recently. Now, there's elements in the fiscal side of France that make that deficit, the trajectory, the projections for that deficit and that debt increase over time, and which are unavoidable. For instance, all this discussion about pension age, etc., it's something that is unavoidable and will need to be addressed in most European countries. So not addressing these issues is a problem, but it's also something which is very short term. Whenever government comes in, when stability comes, will one way or another need to produce some kind of solution. And we will see what solution they bring forward at that point. To me, the problem of Europe is a little bit different. The problem of Europe is lack of growth. If you have growth, a lot of things work. Your budget works, your expenditures work, and growth is obviously a matter of the policy rates, is obviously a matter of where the private balances are, but it's also a matter in Europe, in this time and age, it's also a matter of whether you are doing enough investments. And I think that in all this, people haven't paid a lot of attention to the Draghi report and its recommendations. Europe needs to have a sweeping delta in terms of the composition of its budgets, in terms of regulation, to be able to withstand this huge war that has started between US and China in terms of competition. And the conversation is not there. We haven't even started to discuss that. Those measures would near term increase the deficits probably. I mean, Draghi has spoken about nearly $1 trillion per year of cross-European spending. But the medium term, I think they could put fiscal finances on a better path because they would preserve growth to some degree.
In that context, would the ECB come to the rescue in order to support this growth and this investment? We have a meeting in the next few days. What is your take on the ECB monetary policy? Are they going to be more aggressive than what the market is expecting? We are talking about 50 basis points and maybe 2% by next summer.
I think that you hit the nail in the head there. When the other policy levers are incapacitated, the monetary policy needs to do a lot of the heavy lifting. Our forecast is for policy rates to go to 1.5, so slightly below where the market is priced. If you look at where the long end of the rates market is expecting rates to settle, it's at 2.2, which is quite high. So the risks are skewed for rates to go lower than what is expected. I would add to the fact that to that point forecast. The point forecast is reliant on two things. The first one is that this is a slowdown of normal proportions, and second, that if you cut rates to something like 1.5, the economy picks up again. So you are in loose monetary conditions. However, if the net effect of Trump tariffs and China's subsidies is that Europe goes through a few years of deindustrialization, then it could well be that ECB finds itself easing, and that easing not producing the desired results. And that could mean that rates go even lower than that.
Okay, so in your words, then, if you have a divergence in growth between the US and the eurozone, and maybe a divergence in monetary policy direction, that means that your forecast for the euro is for a lower exchange rate, if I'm not mistaken.
Correct.
And
So,
Barclays forecast for the euro is how much for the next 12 months?
so by now it's not that far as 104. When we put it out, it was 4 or 5 percentage points lower. The market has moved in that direction. I would say that all forecasters tend to be a bit shy with their point forecast. If I was to fully apply, for instance, what Trump has said in terms of tariffs to the euro dollar, that would bring it closer to parity. So the initial forecast was 104. At the time of the forecast, that looked like a good enough move. Now we are 105.50 at the time we're discussing. And I would tend to say that under certain conditions which we put high probability in, euro dollar could be even lower, with a risk scenario showing it closer to parity.
With all these geopolitical events that are taking place, the tariffs from Trump, the Chinese factor, the anemic growth in the eurozone, the debt trajectory of some countries like Italy, like France, like Greece, are we facing the threat of another European debt crisis? And if we are, do you think that the eurozone and the euro will survive the next decade?
It's a very good question. I think in many ways we're entering a phase that has the characteristics of a very severe set of risks towards that direction. There's one big difference with the debt crisis of the past decade. In many ways, there was a very heavy element of political weight and gravitas in the previous crisis. The core demanded certain policies from the periphery in the past crisis. The periphery was not always able to produce them, and the core put higher and higher conditionality on support based on whether they would meet those reform targets. So in many ways, a big part of the European crisis was that the support, monetary or otherwise, was conditional. And if you didn't meet those conditions, you could exit the euro, which Greece came closer to. And it created a certain type of crisis with peripheral spreads blowing up and the euro coming down. This time around is the core that's going to be ailing. So there's no political setup where Europe turns against the main decision machines, which is France and Germany. What I worry a little bit more about is a different kind of a soul searching or crisis for Europe. For instance, if the narrative is that the reason why we're having these growth issues is because of the Schengen Treaty, or because we have too much openness in borders within Europe, starting to question European institutions is a different way of approaching a crisis, and that can be a lot more risky in the medium term. Not reading the problem is something that Greece did very early on. It led to a much bigger problem down the line. It's very natural. Europe, France, and Germany not reading what the problem is at the moment is a bit worrying.
Good. We're going to move to the US now. How would you explain the resilience of the US economy despite still elevated interest rates?
3 reasons. 2 a little bit short term, the third one a little bit more long term. The first reason is that the way that Americans finance themselves is a lot more geared towards fixed rate financing. So if you look at the actual financing costs, for companies and for households. Up until last year, they were decreasing.
True.
So the average American hasn't really felt the bite. Of course, pricing happens on the margin. So it's all about the marginal borrower, the marginal lender, the marginal price setter. And that tight monetary policy has had its effect on prices. But it also tells you why some of the effects of policy rates on existing balance sheets, legacy balance sheets, have not been as tight as people would have expected. That's one. The other reason is because, whether we like it or not, an extreme amount of money was put into the U.S. economy in the fiscal easing, and during COVID, and that is not to be. One needs to think a little bit about that. In Europe, for instance, we gave companies loans. In the U.S., it was grants of the order of trillions. In Europe, we gave people furloughs. In the U.S., we gave them handouts. That led to a very big increase in debt, a very big increase in the current account deficit during those years, which was financed monetarily. But what has meant in the next few years is that US households and companies have had low savings rates without that leading to a deterioration in their credit condition, etc. So you can see, for instance, that the current account is at 3%, despite the fact that the savings rate is very low. They're consuming vast wealth. And actually, if you look at these measures and estimates of excess savings, they've gone through several revisions. Every revision tends to revise them higher. If we're now to look at what the excess savings were 3 or 4 years ago, it must have been enormous. So that's one thing. Obviously, as Americans consume, and they like to consume, the labor market is very hot, the wages are high, etc. And because this is happening on past borrowing, it's not affecting sustainability in today's day and age. The government has also kept a loose position. Now, I wanted to make a little bit of a statement here, which is a little bit more medium term. I think that when we look at debt globally, we tend to look at the budget deficit and not distinguish between deficits. In the US, the budget deficit is large, but a very large part of the budget deficit has been spent on things that will pay off in the future. For instance, the Inflation Reduction Act and the CHIPS Act are monumental pieces of legislation that help companies move their production to the US. So it's supply enhancing kind of regulation, right? It's the first industrial policy that the US has had in 50 years. And this is coming, just a decade after deregulation of the tech industry has led to a massive boom in the tech industry in the US. Just to give you a sense, I would like to ask you, if we had Microsoft in Europe, how many Microsofts would they break it down to? I'm pretty sure there would be a Czech Microsoft, a Greek Microsoft, a French Microsoft, etc. And vice versa. Would it have been allowed for an entrepreneur from South Africa to launch satellites in the sky, for instance, at will? Probably not. Same in China. When that industry started to build up, it was very heavily regulated from day one. The US has had an unregulated growth of the tech industry that has attracted jobs, capital, and a lot of money into the US. And if you go even further beyond that, the US has invested tons of money in becoming an energy superpower. Now they're a bigger energy producer than OPEC. To make a long story short, for 20 years now or more, the US has been investing in becoming more and more self-sufficient, more and more closed, and more productive in terms of the breadth of things that they're producing. And that gives dividends in ways that other economies that haven't done that work do not reap.
I like your answer and your explanation because it makes me move to the upcoming administration and their intention to impose tariffs on imports. And what would be the impact of these tariffs on inflation and then on the Fed policy? Because if the economy is going well and inflation is not yet at target or below target, I guess that the Fed is not very interested in easing monetary policy any further.
Correct. So we've pared back a lot of our expectations of cuts. We now have three more cuts until the end of next year, including, and we all know that the December one is, you know, there are a lot of discussions around that. The oops, can you still see me?
Yes,
Sorry, I'm facing a little bit of a technical issue.
I can see you. We can see you.
Okay. Now, if you look ahead, you can definitely, there's a lot of debate about tariffs themselves, whether they're ultimately inflationary or deflationary, because they are a tax hike. So the first order, they could be inflationary. Some people say they could be deflationary in the end. I doubt that. I think that the purpose, what they're trying to achieve in the U.S. administration, is to bring, to favor domestic companies, basically, right? So they will create a tariff schedule that is avoiding the areas that is very counterproductive, and it targets areas that is very meaningful and favorable for the US. Now, as you know, in micro, we are taught that any tariff creates, a surplus for the government, takes money from the consumer, benefits the companies, but it leaves you with a deadweight loss. I'm pretty sure that fiscally they would try to offset that. And for us, we don't have a huge amount of worry about whether the tariffs themselves have a negative impact on growth. We would probably see them to be more inflationary near term. The main question, I think, is that our economists are trying to answer is how strict Trump will be on labor supply, so migration policies. And that is a big question mark and up for debate. But I would tend to think that tariffs themselves will be, to some extent, offset by some level of subsidies, and they will deliver more damage outside of the US than inside the US, for sure. And on the net, probably a little bit less deflationary than more inflationary than deflationary. Sorry. Now, a tariff, as you know, is also an artificial way of cheapening a currency. All of a sudden, you have two goods. One is now cost 60% more, so you buy the other good, and the market moves to offset that. So there will be a dollar move on the back of that. That said, the dollar feedback back to the economy tends to be a little bit smaller than people make it to be. So the deflationary effect of a stronger dollar is not very high.
So a combination of a tighter monetary policy in the US relative to the rest of the world and the impact of tariffs on the dollar would mean that the dollar index should continue on going up.
Correct.
Okay. To move to emerging countries, I know that you are a specialist in emerging countries as well. I would like to ask this question about the geopolitical divide between the G7 and BRICS. And what is your view on the de-dollarization trend that is going on, the discussions in the world economy between leaders?
So it's a very good question. I wrote about this a couple of years ago, but my views remain the same. The main problem that you have in any de-dollarization conversation is what is your alternative? Always. The rise of the euro a few decades back gave the sense that the euro could be an alternative. We have seen that, especially because of the European crisis, putting a question mark around the longevity of the euro. That process of people moving their reserves to euros came to a halt. In other terms as well, which euro do you invest in? You put your money in Italian bonds in euros, Greek bonds in euros, or French bonds in euros. And you yourself have asked the question of when are we going to see the next crisis? The other property of the euro that has not been as appealing is that it is not as counter-cyclical. At the same time, it hasn't detached itself from the financial system where the dollar is dominant. So the rise of the euro has come to a halt. There's a lot of question marks around whether the Chinese yuan will be the next dollar. And the Chinese have made a huge amount of attempt to use the yuan more and more in transactions. So you are seeing an increase in the usage of the yuan for transactions, primarily on bilateral trade with China, and primarily, with quote unquote emerging markets, if you want to call them that way. A lot of them are now quite developed. But whereas Russia, whereas the Middle East, whereas Latin America, there is that kind of momentum. The problem that you have for CNY is whether you can store reserves in CNY, and that's the biggest issue. And what do I mean by that? If I am a big sovereign, let's say I'm Saudi, and I have tons of dollars to store somewhere, and I want to store them in CNY, I have two options. The first one is I put them in a CNH, which is a proxy, very loosely linked with actual CNY. Or I put them in onshore CNY. But if I put them in onshore CNY, there's capital controls, and I cannot move them out at will. This is why there's a big discussion. There's a lot of buzzwords, but the IMF has always said, the internationalization of the CNY is required. What do they mean? They need to let the currency be a proper currency, basically, right? Now, this goes to the problem of how's China growing. The reality is that there's a trade-off always between relinquishing control for the authorities and growing something. So the time has arrived for the CNY to, be less managed, less tightly managed, but the authorities are worried that if they do that, then that could cause volatility, and they don't like any kind of volatility. So in this trade-off, the Chinese authorities have leaned more towards more control, which has held back the CNY. So for now, because of that choice, the international role of the dollar remains intact.
Okay. For growth for this part of the world, do you think that China and India will maintain their strong GDP growth rates in the upcoming years? I know that the growth rate has dropped to 5% and maybe a bit below, and India is doing quite well. Is there a shift from China to India, the next industrial base of the world, for example?
Most definitely. India is going through this very virtuous cycle of reforms, investments that deliver infrastructure, deliver competitiveness, that deliver openness, capital inflow, etc. And this is a policy that increasingly is becoming more and more a backbone of how they're viewing their own growth model. They have such demographics, so much space to catch up, that is nearly frightening the potential there, both in a good way, from an investment opportunity, growth, human scale, but also negatively as well, if you think about the environmental costs of such a huge population moving very closely to a consumption model more often seen in the West. China, on the other hand, is likely to undershoot. There's a cohort of issues that China is faced with. They have a housing situation which has blown up, and they haven't addressed it in full yet. They have a policy direction which is stay competitive, keep wages low, prices low, so we can gain market share. And that means that the government is very averse to doing big stimulus that could raise prices and reduce competitiveness. And crucially, the Xi administration has moved away from the conventional wisdom that they used to have 10 or 15 years ago, that China needs to become a consumer-led economy, more liberal, etc. And it's more and more going down the path of controlling every single sector which has its positives, it has its big negatives as well in terms of performance. To me, I think China seems happier to undershoot by a little, as long as they have a certain set of policy goals met, which are not economic in nature. And it reminds me a little bit more of how Germany used to see growth 15 years ago, the beginning of the European crisis, putting moral hazard above economic outcomes. I think China's policy priorities are more geared to that direction.
Are you positive on the Asian EM currencies except India? I
No,
mean, these powerful industrial bases like China, Thailand, South Korea.
quite the opposite. I think that you know a lot of these economies, and particularly China, which is the anchor currency in the area, are going to be hit with. First of all, let me just say that Asia is in the middle of a trade war. It started with the first Trump administration. It escalated with fiscal subsidies in US and China over the last administration, the Biden administration. It is only natural to expect that this trade war will only further escalate under Trump, one way or another. There are lots of ways you can respond to that, but the most natural and obvious way is through a weaker currency. And why am I saying this? This is an economy that is in deflation. They will be hit by an external shock, which is basically making their prices higher. If they want to address this without currency weakening, they'll need to internalize it and bring prices even lower, so bring more deflation. So at the moment, they have a policy conflict. Either they go for further deflation or for a weaker currency. And I think the weaker currency is a lot. It's a policy choice that a lot of countries would love to have had. Now, how much weaker? We did this analysis where Trump is true to his word and he does a 60% tariff. China retaliates halfway. Economic models would put dollar China above 8 in that setup. And if dollar China is above 8, I guarantee you, and you don't need that guarantee, you've watched the market for ages. You know that dollar Thailand, dollar Taiwan, dollar Malay, dollar Sing, they're all going to go proportionately weaker, basically.
I guess that the Japanese they kind of anticipated this trend and they took the opportunity of the rise in interest rates in the US. They kept their policy intact, negative interest rates. Now recently they started raising rates, but the impact was like a much weaker yen. I was very surprised that the Chinese did not follow suit. I mean, the Japanese are direct competitors to the Chinese. So what you're saying is that the Chinese maybe they're gonna follow the same policy decision.
And to your point, if you look at the bilateral trade between Japan and China, it has benefited Japan disproportionately, exactly because of those currency shifts. To me, it's one of the puzzles of the days. And you get a lot of our clients asking us, why on earth are they keeping the currency so strong? Again, we're not in their heads. I'm pretty sure there's political issues around it. It could be that these decisions need to come from high up in today's China's setup. But I think that the penny will drop.
Now the Japanese are kind of like starting to reverse slowly, gradually policy because of their worry about inflation going out of hand. So do you think that the yen carry trade is over and we cannot anymore bet on that trade?
At the very least, I think that there are, for investors looking to fund or for investors looking for hedges, to me, it's more straightforward to think of non-Japan Asia currencies weakening as a better risk reward than Japan. Now, Japan will be more hawkish, as you say. US rates will probably push the other way, so for a weaker yen. The other thing that worries me a little bit with the yen is that this is the only place where if Trump was to push, there could be some mutual agreement for a stronger currency, because don't forget, they have intervened to keep their currency from weakening. So there's a lot of questions about a Plaza Accord. The only place where I could see that Plaza Accord being mutually acceptable is Japan. So although I'm not going to turn very positive Japan, I think that is not the top order of currencies in terms of weakness.
Okay. To move quickly to our area, the Central Eastern Europe, what is your view on the Eastern European currencies?
Um, it's a very good question. Um, the general prospect from our side is that A, there's a negative growth shock from Germany. B, policy easing has variable rates of impact on currencies. And C, different economies are doing differently. But importantly, the prospects for a ceasefire or an end of the war in Ukraine and Russia affects different economies differently as well. Weighing that all together, we have generally thought of Poland as more resilient, link. So that divergence we have caught well. We have also expected that the Czech National Bank's easing prospects would have had a weakening effect on the currency. And that, I think, has been an area where the market has been a lot more resilient than we would have expected, basically. But generally speaking, I think that one of the big pictures is that Poland is coming out from a number of shocks, being a lot stronger place than Hungary. And the other big point is that, particularly when it comes to monetary policy easing, Czech has a lot more space to ease.
Well, we are planning in February to do a brainstorming, like a roundtable, because the exposure of the Central European countries to the industrial sector of Europe is quite high. And if we have problems in the main countries in the eurozone, these countries in Eastern Europe will be affected greatly. So yeah, it's very interesting for these countries to maybe to shift their economic growth, not to rely that much on the eurozone, main eurozone countries.
And it's interesting to observe it in many different ways. For instance, if Germany loses production, naturally there will be a loss also for Central Eastern Europe, but maybe historically that accelerates also some relocation of production from Germany to Central and Eastern Europe. So maybe there's winners and losers. I definitely think that the results of that brainstorming would be very useful to read.
Well, we hope to host you over there and for you to be part of it with your team from Barclays that covers the Central European countries. Thank you, Themos, for this very, very insightful podcast. And we hope to see you soon, either in London or in Prague.
Thank you, Andre. It was a great pleasure and a great honor as always, and good to see you as well.
Thank you, Themos.